moving average, relative strength, on balance volume. Well, let's kind of narrow this down. RSI, relative strength indicator, or index, I should say. This is a momentum indicator, so of course it's not going to be a trend indicator. On balance volume, well, that's a volume indicator we talked about, so not a trend indicator. This is kind of left with moving averages and charts. And while both of them might seem like they're okay, really the better answer we're going for is moving averages is the answer that we're looking for trend indicators. Now, which of these is a momentum indicator? Well, you kind of addressed that real quick. RSI, as I said, was momentum, and if I can highlight just RSI, not on balance volume, we'll do that. And which of these is a volume indicator? We'll kind of spilled the tea, so to speak. The first question on balance volume was that volume indicator, kind of has volume in the name. It's a does help kind of show some of that trend and such with that. Now, the fourth question, of course, there's 4 answers here. So obviously it's probably that fourth one, but which is a price indicator. And now reading this about price, we know that's what charts are showing us is where price is, where price was. And so naturally it makes sense that charts is a better answer for price than charts being an answer for trend. Now that said, you can of course use charts to identify trend, identify momentum. And some experienced technicians, they don't need indicators to identify this, but really the best fit we're looking for, of course, charts helps identify price, moving averages, of course, for trend. What are the 4 types of indicators that technical analysts should use? We've kind of given some hints here. Some of the big ones, the 3 big ones, of course, from up above. Trend indicators, momentum indicators, volume indicators. Those are 3 big ones. It's what we used to call the pillars of technical analysis. But what's increased in importance, of course, is volatility indicators. Volatility indicators are a lot more important now than they were 30 years ago. I remember saying 20 years ago, but I've been on the strategy desk for about 10 years now, and so it's closer to like 30 years now versus 20 years ago, so to speak. But I say it because, well, in early 90s, what was not really available to the modern trader, the regular retail trader? Computers. You had less of an opportunity to use computers. I remember late 90s, even early 2000s, my parents still calling into their broker to place trades on stock and, swing trading and, telling them off. Sell when it hits 80, but buy it back at 70 and, doing well at that, but still everything was done through their broker and not through a computer. So as such, with that, the ability to, look back and crunch numbers and, do things like, run historic volatility information for volatility indicators, that's kind of come a long way. I also remember one point in time, my mom using, Lotus 1, 2, 3 and such, the Excel spreadsheet. She'd update one thing and go line by line. Can you imagine something like that? You're changing your indicator from a 20 period to a 21 period and you have to go day by day, updating everything. Well, 30 years ago, so to speak, 40 years ago, that's what it was. And so that's why we've, of course, seen the rise in those volatility indicators that they've been easier to use with computer processing and such. As such, also with computers and such, the rise of higher frequency trading, traders have started to rely less and less, of course, on volume. So I've kind of really gone in depth on that trend, momentum, volume, volatility. But, if you said price, we'll accept that answer as well with that. And the name one volatility indicator, we've kind of touched on this a little bit. I've kind of opened up that box, so to speak. I already mentioned like historic volatility, talking about standard deviations. Some other ones that are quite common: Bollinger Bands, Bollinger Band width. Of course, Bollinger Band width and historic volatility is going to be pretty much this, very, very similar with that. Other ones that are pretty common, I know we talked about last week: average true range, average true range percent. Those are some other common ones that many of you in the audience might have used. But another spot that you could have gone to when you were maybe labeling some of these and such. And I'm just going to pull this back up over fidelity.com. We're going to go to news and research. And we're going to go down to learn. Once the stock research page loads, and it lets me come down to learn. So let's see. There we go. News and research. Learn. Over here on the far left side, topics, advanced trading, technical indicator guide. And then, of course, from here, scroll down, volatility. We've got a bunch of answers with this. I already mentioned average true range, Bollinger Bands, and such. Historic volatility and such are some really common ones. Now, VIX, the VIX index gets into expected future movement based on options pricing. It's another way to gauge what's expected in the future based on options pricing versus what the stock price has actually done in the past. So VIX, of course, is broader market though, compared to security specific like some of these other ones. So a lot of different answers you could have chosen from. So coming back to the homework, hold up the technical indicator guide already. Screen for each of the 3 indicator types. Screen for, of course, volatility there. Add some to your charts. Look up a symbol. What's the trend the stock is in? Look at these 3 indicators. Is there any evidence of change in trend in the chart? And so maybe to kind of cheat a little bit, pull this up. We go to charts. I actually have a saved chart right here. I'm going to say basic. We'll do SPX for broader market. Now you could pick SPY, you could pick an individual stock and such, but we have a 1-year chart on here. What does this kind of look like from here with the broader market? I'll give a hint. It starts at the bottom left, ends in the top right. We have higher highs, higher lows. This is an uptrend, but how can we say it's an uptrend? How can we prove it's an uptrend using technical indicators? Kind of going back on what we talked about previously. Well, what are our trend indicators saying? Well, our trend indicators are showing us that prices above the 5 period, the 20 period, prices above the 50 period, prices above the 200 period. All 3 of these are sloping upwards. So therefore, we know intermediate, short-term, long-term trend is up. In addition, recently, we had short-term trend down, short-term trend back up, and then again confirmed a little bit additional strength right here with the 20 crossing above the 50. So again, this is showing that trend currently is up. Now, very short term, we did add a 5 period of this chart. Price has been interacting with that. Yesterday it dropped below that. So very short term, could have been kind of turning a little bit. But what about momentum? Talked about trend. What about momentum? Well, now we mentioned this. It's a great example of divergence right here. Momentum's lower highs, price higher highs. We had some divergence here. But even though you might see this, you want to look for these signs of trend changing. And really what these signs of trend changing might have been is over here, where price broke below these moving averages. But we then had it recover, and now we had a higher high. And we do also see momentum slightly higher high right here. So we're not quite hitting lower lows, so to speak, but still from over here to over here, still not higher highs. So one thing I like to mention as far as momentum goes, as we talked about last week, foot can be on the gas pedal for quite a bit of time as you accelerate. So just because this is an overbought territory doesn't mean this is a sell. So you'll still want to look for that confirmation with indicators and such. And then just add one more, OBV for on balance volume. What is it we're seeing right here? Again, just like we did with momentum. We saw going into this about right here, lower highs. We're seeing that negative divergence here. And then, of course, we're seeing price come down naturally as we'd expect. Now on balance volume is going back up with that. So that really wraps up the homework. I do now want to very, very quickly, jump into content we want to talk about for the session today. So that said, if anybody has any questions on the homework assignment, please feel free to send them in. We'll try to answer them as we can. But we do, of course, want to cover all of the material we have today. With that, I've been talking for quite a bit of time. Peter has joined us. I know he you mentioned he was just running a little bit behind. He was working with another presentation and such. But that said, Peter, why don't you talk with us a little bit about different things on patterns and kind of thinking about some of their limitations and such, different things that traders will look at before we actually kind of jump into specific patterns.
Yeah, no, happy to. And there's a lot to this. I think when we talk about patterns and the thought process behind it, there are going to be characteristics, right? That all of these patterns are going to have, or maybe share. I know in the Q&A there are some number of questions about indicators. We'll try our best to try to get through as many patterns as we can. Truth be told, we're not going to be able to cover them all. And then if there is time towards the end, maybe cover some of those additional questions as well, or maybe even show how oftentimes lots of these can kind of play in together and be at numerous zones where lots of these, whether they're indicators or patterns, are kind of all working maybe in unison, or maybe, if nothing more ironically, kind of coinciding at similar price points. Having that said, though, back to the characteristics that I was referring to and thinking about patterns, what I meant by the characteristics are, when we're thinking about patterns in general, the commonalities that you're going to find are more times than not, they're going to be bounded by different lines, whether those trend lines or lines in general are straight, whether they are curved, or whether they have some type of slope to them, upwards or downwards. Think about what we had talked about previously with drawing trend lines. Some of those trend lines have a upward or downward tilt to them. Some horizontal lines like support and resistance are just that. They are pretty much dead smack in the middle of a chart, and they are just moving from left to right. But these kind of, I guess, lines themselves are what are then going to be kind of the building blocks, maybe the framework, or maybe if you're thinking about bowling, kind of like the gutters on either side, maybe of price action over a period of time. Now, with those patterns, if you're talking about, gutters on either side of a bowling lane, well, there are going to be times when it's entering or exiting out of that pattern, potentially kind of breaking velocity and getting up and out of maybe a range or a pattern that's being seen, or maybe it's falling down below and price action actually heading lower. Now, to that thought process on entries and exits of the pattern itself, that's that third bullet point about patterns generally being classified as either continuation patterns or historically maybe reversal patterns, or at least maybe a flag or warning sign that, hey, maybe a percent of the time, this type of pattern is often signs of a reversal. Doesn't mean that that is a fact, does not mean that that is what is going to happen, but it is something that you may want to take note of. So in thinking about patterns themselves, there's numerous ways to group them. And I'd say pretty broadly, continuation or reversal, meaning is that trend going to maybe pause for a moment while it's in that pattern and then continue the longer term uptrend like we learned about in previous weeks? Or has maybe the prevailing trend, we'll stick with an uptrend, is maybe that prevailing longer term trend beginning to see some short term stagnation? Maybe that now longer term trend that was, generally speaking, kind of up and to the right, making higher highs and higher lows. Are we now seeing price where it's making maybe a lower high and a lower low, or maybe an equidistant high and low, and maybe showing us that, hey, that general uptrend begins to actually look like it's breaking down, and now is maybe at a maybe inflection point where this could be reversing and heading lower, in the case of what was a uptrend, maybe turning down, doing an about face to a downtrend, and then vice versa. Maybe something's beat up for quite some time. Now, maybe being able to kind of round out on a bottoming, and then maybe actually show signs of reversing and pushing higher from the prevailing downtrend that it had been in. You heard me already talk a little bit about that next bullet points, the fractal nature. We talked about that, some of that previously, but all that that means, it's that fancy way to say that whether we are thinking about these patterns, they show up on a daily chart, meaning that, okay, if we've got maybe 50 bars worth of price action, and kind of take a step back or squint, is there maybe a pattern that is forming? Well, you could be looking at 50 days worth of information and the same kind of shape or the same formation that might be evident or seen is going to be able to show its way into a weekly time frame, maybe a monthly chart. Now, obviously, if it was 50 days worth of info, well, maybe a similar pattern or some of those similar characteristics I was referring to are showing up in something like a weekly chart. And then, of course, given how many minutes there are in a trading day, there's oftentimes the ability to see many of these patterns that are showing up in a minute chart as well. I like to pause there for a minute, Nick, because I think when you look at patterns in general, whether you're looking at daily, weekly, minute, go back and don't lose sight of the fact of what is it that we are trying to do when we're classifying price action in a pattern. All that we're trying to do is give it some general characteristics, which goes back to what I had mentioned previously. Am I noticing that price was on a pretty even upward slope and now maybe is going sideways? Was it maybe heading lower and is now maybe making a bottoming process and actually heading higher? I think that when you look at the patterns themselves, when you break it down into smaller units, those very, very basic and foundational concepts that we started with week 1 and 2 about support resistance, about maybe a trend and about higher highs, higher lows, lower highs, they're all going to kind of find their way into the patterns themselves. It kind of just depends on what is the sequence that you are observing. And that's some of what we're going to break down here today. I think that last bullet point, pattern not completed or activated until that breakout occurs. What we mean by that, folks, is there are probably no shortage of books that go and say, hey, I've back tested such and such a pattern. If this pattern happens, there is a X% chance of this happening next. One, take caution with those types of resources, not to say that they're not useful from a thought process standpoint, but what this bullet point is speaking to is that maybe someone spent thousands and thousands of hours of doing those back testing, of giving that kind of criteria in order for it to count or constitute this type of pattern for such and such a success rate or for whatever their thought process is that's going to happen, quote unquote, next. Do be mindful of two things. One, it's not going to really fit the mold for those statistics to be true until that pattern actually does break out. Meaning, if you're seeing something like I'm sure we'll talk about later, a head and shoulders, but it doesn't break the neckline, your profit targets shouldn't really be where the broken neckline is because it hadn't broken it quite yet. And if you're trying to kind of impose your will or impose a trade on one, a pattern that's not complete, or secondarily, a pattern that maybe did have a breakout, but then is a false breakout. Maybe it broke that neckline, for a day or two, Nick, but then it got right back up into where that, shoulder was for that head and shoulders pattern. You want to be mindful of a pattern not being complete, and then also a potential pattern getting invalidated by a false breakout, like we had talked about a little bit before. There are limits, some of which I had already talked about, which I think is on this next slide here, just kind of keeping in mind those human tendencies. Nick, I think I've probably been guilty of that, whether it's an indicator, whether it's a pattern, whether it's something I'm learning about. You spend an hour reading about a topic, a subject, and what do? You want to use it, right? Why did I just spend this time? It's because I want to use it. It's almost like I say, you ever noticed a car, maybe a unique car, and you're thinking, wow, that's odd. I never see that car, never see that color. What seems to happen next? You start seeing it everywhere. On your drive into work, you're like, gosh, I'd never seen that car before. Now I'm seeing them everywhere. You want to be mindful that you're not kind of imposing your will, making patterns kind of seem to be where maybe they are not. which is why there is a art and a science to this. But that's why if you are going to be using patterns as part of your analysis, you do want to make sure that those characteristics or frameworks are within reason, kind of where they should be, rather than giving too much leniency and saying, well, I think this is a trading range. Well, if it's clearly not a trading range, if it's trending higher or lower, then you can't really trade that pattern like it is such. So just be mindful of that. And I think that kind of goes back into a couple of those bullet points, trading without the evidence, or that last bullet point of sticking with those original price targets of a pattern, even when conditions have changed. And that's kind of that example I gave previously. Maybe you're looking at a head and shoulders pattern, you're thinking maybe there's potential for a profit a certain zone or two. If it gets invalidated and you're still clinging on to that profit, it's looking less and less likely from a probability standpoint that that's actually going to come to fruition, and you're setting yourself up potentially for a large loss, or kind of hanging on to a situation that doesn't quite exist. Now, there is no shortage of techniques for trading. I'm sure that we can go ahead and talk about that quite a bit more. But before we do, Nick, any of your general thoughts, any shape that you like to give this conversation for clients, especially those that might be newer to these concepts?
One big thing I want to mention, of course, is that you do need to wait for the pattern to complete. So often we'll see things like I'll get asked questions, hey, is this a double top? Is this a triple top? Is this head and shoulders? And kind of the answer is like, well, we'll have to wait and see. So keep that in mind on, why patterns exist, what causes patterns, kind of the market mentality and such, that even if you think about things like the head and shoulders, it's the typical higher. Excuse me.
Bless you. Bless you.
There we go. It's, you're having a, higher high, higher low, higher high, so to speak, higher low, higher high, higher low, higher high, and then maybe not quite a higher low, and then it's not quite a higher high. And it's the natural where we're seeing that kind of slowing down and such, and that's what a lot of these are. And you just have to think about, what can kind of cause these, which way is it going to continue, but always be looking for, confirmation and such. The big thing again is what's going on, whether it's backward looking, forward looking and such, that technical analysis isn't predictive. It's not predictive in nature. So keep keep that in mind. And also this last thing, conditions. What are our conditions? Things can change, and be okay with updating your thought process. That just because the if you're bearish on something and things are now flipping bullish, be okay to go, okay, let's get out of this position, let's close out, or vice versa. That don't be, keep holding it down further and further and further with that. So that said, let's go ahead and jump into some other basics with pattern trading. Many of you have, of course, heard about a lot of these. We talk about breakouts, stops, both entry stops and protected stops, retracements and such, and all this. And so one thing I want to mention on an entry stop is this kind of gets to be an advanced usage of a stop. So think about, you have a resistance point. Here's a great example of this. You have a resistance. Stock kind of comes up and resists with that, not wanting to go through, resists here, pulls back, and then comes again, but this time breaks through. So this kind of gets into that breakout. We have a breakout, have an entry stop, so to speak. So with that breakout, we have a breakout. Traders might trade this. Now, if they see this coming down and they think it's going to go back up, they might do something like set a buy stop that will trigger. Now, why a buy stop versus limit order? Because let's say this is $100 and you say limit, $100.25. Well, we're at $99. What's going to happen? 99's at or better, you're going to get an immediate fill. So you'll set that stop so that as it goes up, your order won't trigger until it breaks up. This actually is a great example when I see stop limit orders used, because they might say it breaks up above $100. It's the stop trigger is $100.10, but they might say a limit of 101. So if it breaks and then boom goes up a lot, or if it goes up overnight, it gaps. Well, they don't want to pay up here after the move has already happened, so they might kind of limit that. So you see stop limit orders used more with entries versus exits. So a couple of different things to think about with that. Now, we also address different filters and such, and this becomes important. Do you enter when you see it break out intraday? Hey, it's in the middle of the day, it broke out, go ahead and buy. Or do you wait for a close above it? Do you wait for more than one close above that? Do you wait for it to be above it for so many periods of time, so many days? If we're looking at days still, look for it to be a percentage above it or a flat dollar amount above it. Some great examples, of course, on the chart here. And I'm just going to close this out. We'll minimize this. So with some of these, when would you get out or get in? Here, let's look at this. So we see this kind of touches on this. Well, here we had a close above this. You might have exited down here at the close, not at the open. Or maybe you waited for a second day to close above it, so you might have closed here. Or a certain percentage beyond that. You're doing a 2-day basis to get out. Well, you've gotten out, and then it came up, you'd have gotten back in over here, and then you wouldn't have gotten out on this one because there's only a 1 day below that. Different ways to think about that. Or would you have done it on a intraday basis, so to speak, just because it ended up below that intraday? And we can find some other examples where it's kind of done that on an intraday basis. Let's look at this right here. Here's a great example of that intraday basis. It opened here, and it did touch below this intraday. Would you have gotten out and then gotten back in as it came up above that? So these different filters and such. Now, one's not necessarily better than the other, so to speak, but there are pros and cons, so to speak. Whipsaws. If you go intraday, you're likely to get, whipsaw because it, recovers or it moves beyond that, back beyond that on an intraday basis. If you do it multiple closes, 2 closes, 3 closes, well, you might kind of miss out, so to speak. And so there's pros and cons to each of these different types of filters. Kind of already talked about entry stops. This right here could be that risk of limit orders where it breaks up and it kind of gaps up, so to speak, above that. Now I want to start to talk about some other things dealing with false breakouts, and seen this happen, with some frequency. And I'm going to pull up another quick chart. This is one that we talked about beforehand, the Russell, back to 5 years. Draw a horizontal line right here. Let's zoom in. What do we have here? Touch, 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 breakout, and then throw back into below it. It's a great example, a live example on an actual security of a false breakout. So up to here, we have a breakout. This is a breakout. But once this happened, is no longer a breakout. And actually, what do we then have? We'll draw a line down here on the bottom. Bounce, 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 breakout, through back in, bounce, bounce, boom. We now have a breakout on the bottom side. So keep that in mind. A lot of breakouts, you have bull traps, bear traps, and such. It all depends on this, that if you see a breakout, you might want to keep a fairly tight stop on that. So kind of going back to this example, when this happened, like I said, you buy in the intraday. You wait for a close above that. You wait for more than one close. This line could have been also a little bit higher, and so this one might not have been above it. Might have entered right over here or over here. Things could depend on what level you chose. But the big thing is if you're looking at this to be your entry point, you might have set something like that or a little bit higher to be your exit point. You might have had a very, very tight stop that way. Yeah, you entered in over here, trying to ride this up. You see it kind of start to fail back down. And then you'd have gotten back out over here, for a smaller loss, so to speak, as opposed to then holding and then selling it back down here. Some different things to think about and to consider. The protective stops, they protect your capital. And here's another example of this. You might have bought on the breakout, so to speak, but then had a protective stop down here. And different traders might have different levels of risk tolerance. And this could also be that maybe you're looking for it to break out. It's kind of bounced over here. Traders might have been trading this pattern where they saw it bounce down here. They might have bought it when it bounced. Maybe they looked to sell it up here. Maybe they might have held a little bit, looking for it to break through, but then sold it if it fails to break through. So just a couple different things to think about and to look at and to keep in mind and to consider with that. That's you might have a breakout and it might fail. And so be sure that you set stop orders, that you manage your risk to keep that from happening to you, where you're saw it break out to the positive side and you held it and then you're still holding it when it's way down here, so to speak. So couple common chart patterns we'll jump into now. These particular sessions, we do spend a little more time on these multi-bar patterns and some of these short-term patterns. We don't normally dive deeply into candlestick patterns, but this is a little bit of that difference between Eastern and Western technical analysis that we kind of talked about in the beginning weeks. This really is kind of, to me, the crux of it. Eastern technical analysis doesn't really look at these kind of patterns right over here. They look at these patterns, candlestick patterns. Western technical analysis, that's where the head and shoulders, double top, V bottom. Those are Western technical analysis terms. Though Eastern technical analysis does have some similar things where they'll look for patterns that will catch some of those similar things. Now, that said, let's start to jump into more of the meat and potatoes, so to speak, of patterns, different basic patterns and such. Here we have a double top on here. And it's, as it sounds. Top, resistance again. We have one line, does it again, kind of comes back, and then boom, it breaks through. It breaks through this other support line. It might even try and pull back, but it kind of fails on that. And this, you can have a double top. You can also have a double bottom. A lot of these will flip, will inverse. You also want to ask, well, what happens? You have a double top. Well, what happens if it bounces off of this and kind of comes back up? Could then continue to go up, or Could also have a case of the triple top on here and falls back down. Now there's another example I always like to pull up with this. I do believe we'll look at IXIC as a little bit of a better example for this. But I was asked, remember being asked quite a bit of time on this. Hey, Nick, is this a double top? Hey, Nick, is this a double top right here? Came back down. And kind of the question was, well, we'll wait and see. You know, it needs to break down below this level right here. Keep in mind, well, what is a double top? Well, a double top is a trend reversal pattern. So it's also important that it be trending up into this. Otherwise, this could have been, you know, a bottom pattern, so to speak. So fast forward a little bit more. You know, whether you're drawing it here or here, so to speak, during this time frame, I had traders, of course, asking, hey, Nick, is this a triple top? Again, kind of my response is we'll wait and see. And we have this upside breakout. It's kind of confirming that no, this isn't a triple top. And I'm zooming back out again because I had the same thing asked of me here. Is this a double top? Is this a triple top? Kind of the answer is we'll have to wait and see. Because while this might look like this is a perfect setup for a double top, and even in here, shift this over real quick. And then we see this kind of comes back down. It starts to do this. You don't want to preempt a pattern. So you don't want to go, oh, this is double top. It's coming down. Let me go ahead and sell it short right here because it's going to crater. You don't want to preempt the pattern. You want to wait for that pattern to fulfill. And well, what would that take? It would take it dropping back down. Now, if this starts to get into another thing I remember being asked, hey, head and shoulders, left shoulder, head, right shoulders. We'll wait and see because, well, what wound up happening? You know, I was already zoomed out of the chart, so everyone knows we went higher. So no, this isn't. Neither of these wound up being a reversal pattern because, well, we kept going higher. Now, bottoming patterns. So kind of the question, hey, Nick, was this or is this a double bottom, a triple bottom? Now, this doesn't quite line up quite as well. If we do see how NDX lines up on here, it's about the same. You know, we have that funky candle right there. And I'm actually going to shift settings real quick to a line chart so you can see this better. And I've got asked, well, Nick, was this a double bottom? Well, we'll see. Kind of came back here. Is this a triple bottom? We'll see. And then what happened? It's like in here, double bottom. We're looking for the breakout. Didn't quite break out. Triple bottom, maybe it breaks out above that, breaks out above this. When this finally happened over here, you know, kind of reversing this downtrend, yeah, it looks like this might actually be a triple bottom. It's broken out above that resistance line. And what is it we even see? Well, we see it kind of cutting back to that. You know, if you're looking at it like this, resistance, resistance, resistance. Well, even broke out and it tried to kind of pull back to it, and then it continued on. So this does look like, a double bottom, a triple bottom. And if we zoom out back, what we see, this was the bottom. This did reverse this downtrend back up. Now, does it help us now identifying this as a double bottom or triple bottom? No, because we're already in an uptrend on that. But maybe that could have clued you in at that time that when you start to see then something like this coming back over here, if you entered going, yeah, okay, yeah, the pattern's reversing, well, you might have really been keeping your eye on this, that will this break or not? And we see this held, continue up, you might have then continued to hold. Lot of information there. Peter, anything you might want to add to that? Maybe any questions that came in we can kind of clarify?
Yeah, I think maybe a couple things to talk about. One, first and foremost, and I'll grab the screen for just a moment, but many of these slides, folks, are going to have the calculate the target price. More times than not with patterns, that quote unquote target price. One, it's not a hard and fast rule, but I think the thought process is if we're all reading the same technical analysis books, and that's kind of what they tell us the target price is, well, maybe it's some of a self-fulfilling prophecy, but I think it can make sense. More times than not, what you'll find is that it's kind of a measured move, meaning if you have something like a double bottom or a triple bottom or head and shoulders, we're kind of looking for, okay, what was the span, from the resistance to the support? What was the difference between that? So if you had, let's say, resistance at 100, support down at 90, well, that's a 10-point difference. If you then get the breakout towards the upside, like we're seeing now, well, maybe that kind of measured move or target price might be 10 points above where that breakout is occurring. Obviously, that's just a very, textbook definition, but that'll be the same, or at least similar thought process for if you're taking a look maybe at, a pennant pattern breakout or a head and shoulders. What was the, top of the head down to the neckline, and then if it breaks that neckline, maybe where would that come down to? I think the other thing that I would say, and hopefully, these concepts are making sense, but let me just go back to that chart of the cues for just a split second, Nick, and then I'll pass it back over to you because I don't want to step on your toes. But in its basic form, I think what Nick was saying, and what I'm sure is not lost on anyone, is when he said, okay, well, is this a double bottom? And he said, well, we kind of have to wait and see. I completely agree with that. And that's what goes back to if you take a step back and think about, okay, well, what is a double bottom? Well, it's price action coming from above down and then having kind of equal lows with a, peak in the middle. So valley, peak, valley, what's going to happen next? We don't know. However, think about, as I was mentioning, week one, week two, building blocks of technical analysis. Here we are making lower lows, generally speaking, folks, lower lows, lower low, lower low, lower low, slightly higher low, pretty even low. So what has changed? Rather than making lower lows, lower lows, lower lows, now we are more or less making equal distant lows, or I guess horizontal price point lows. Now, does that mean that this downtrend is set to continue? No, not necessarily. But if you're under the impression that what changes a downtrend into an uptrend, well, by definition, it has to be that there is a either equal low or a higher low in the grand scheme of things, as well as a higher high. So if you were to just even so, let's just harshly do this, just even with the time frames that I have, draw some type of linear regression channel over through, well, we're making the higher low, but the linear regression channel still pointed downward with the data that it has. Well, if you were to also do kind of a linear regression channel on the upside and say, well, we made the low point here. This was a higher low. This was a higher low. This was a higher low. We didn't necessarily maybe know, for instance, that we were in a potential uptrend or maybe a channel that's upward sloping until it actually kind of breaks out. So there is this pattern. That's why some of you may have heard me say it's very hard to kind of identify the absolute low or the absolute high in a pattern. And more times than not, it's because part of the pattern or part of where you might be drawing your lines might still be kind of contained in what that more broader or prevailing longer term trend or longer term pattern had been, which is why that fractal nature comes into play. You got to take a step back and say, okay, long term, what's been happening? And then short term, am I maybe seeing some green shoots about higher highs, higher lows? You would have been kind of in that same thought process here, had a higher low, higher low, higher low, higher low, making higher highs as well, which is why that confirmation comes back into play as well. Here, when it tried to bounce, but then ultimately failed, you have to kind of admit, okay, well, that was maybe the potential for a bottoming process and maybe a downtrend turning into an uptrend. But if these higher lows in the grand scheme of things then get broken, well, now the thought process for this uptrend is invalidated. I got to go back to the well and maybe draw new lines if and when I see kind of those higher lows beginning to build. And then, of course, reserving the right to manage risk accordingly if and when that were to break down. So just wanted to go ahead and one, answer the question about target prices. And then secondarily, give yourself a bit of grace. Oftentimes, that pattern that you find yourself in, well, still might have been part of a previous pattern, which is why lots of this is about being able to go back to what the building blocks for technical analysis are, and then kind of implement or express your view moving forward. If you think that that pattern is going to continue, perfect. Try to capitalize on that. That's why we're investing. But also do keep in mind if that were to break down, how am I then going to react? Maybe like short sellers here with kind of this pattern that was downtrending and then began to break out towards the upside. Nick, long-winded way to say, it's all about maybe taking a step back and kind of not missing the forest for the trees as to what makes a
Absolutely.
pattern. More times than not, it's going to be equal distant lows that had been lower lows, or maybe higher highs that were previously equal distant highs, or something of that nature. And I think that once you kind of think about it from that thought and framework, regardless of what pattern you can look at in this deck, hopefully that will kind of make sense of it all.
And I know to an extent, kind of talking about price targets has gotten a little bit ahead, so to speak, of the material so far. A lot of these patterns we've addressed so far, breakouts and such, these are, to me, they're more the base, those basics, those important patterns, talking about trend reversals. When we've been trending downward, we break up above the downtrend line. Now we're trending upward, or trending upward, and we break below that. We're now trending downward. We're this horizontal congestion, and this, to me, what we're looking at with the Russell, this is a great example of this congestion. Of course, the Russell broke up, threw back in, and then it broke below it, kind of more like this over here, and such. Now, getting into price targets, um, patterns that tend to have price targets, or something more like this, a symmetrical triangle will have a price target, and then kind of where it will be is, we see this drawing it from the top to the bottom of the pattern and kind of extending this down like this. So let me kind of show an example on this. We have a company I know that's going to be announcing earnings coming up next week. We've talked about this company in some of our briefing sessions, Costco. So let me actually take a look at this. I'm going to zoom back to a 2-year basis, because this will actually drag it over here like this a little bit more, go out to 5 years, so to speak. Because one thing that many traders talked about with Costco was this right here. Here we have a pretty good looking triangle pattern. It's kind of what we're talking about right here on the slides. And it's almost textbook with this, where there's not a lot of empty space. Okay, yeah, this isn't drawn perfectly on here, but it's kind of coming close to below, above, below. It's kind of coiling. Kind of what this means is a little bit of a consolidation, and eventually it's going to have to break one way or the other. Well, what happened? Well, it finally broke up above this and now kept up with this uptrend. Now, the way traders will do price targets with something like this, I'll just use the rectangle tool, is they'll look at the width of the triangle at this particular level. And so here we have the drawing at that level. And here we can see that width. So just let me drag this over just a little bit. It goes from the bottom of this to the top of this pattern. That might be just a touch high, because we'll start with this touch down here, straight up above it, right up here. This is that height that we're looking at. Now we can take this, drag it over here. And this is giving us our target price. And really, we hit that kind of over here. Now you might argue like, oh, this isn't quite, if this is still sloping up, this isn't quite up here. But I heard this this put humorously on here that we're talking about kind of internally, we're talking about NVIDIA the other day. That if you had a target on NVIDIA, you know, you had it in $400 to $500 range, and you had $1,000 price target. Well, you're at 100% returns, you know, within like shooting distance of $1,000. Do you want to wait for it to kind of hit all the way up here, or do you go, hey, I'm at 99% of my target. Let me go ahead and 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 cash this, so to speak. And so you might be looking at this, and you could go, well, I want it to actually be up here, and you might have closed it out here, or you might have gone, well, you know, based on this over here, like this, this was close enough. You might exit it out right there. So again, a little bit of that, you know, preference there. You know, we talked about some of those exit criterias and such with that. Now, we had just a regular triangle. We do also have ascending and descending triangles. So a ascending triangle is like this. It's a resistance line with a support line coming up. Here's a good example of that. Resist down to the trend line, resist down the trend line. And then we have an upside breakout. It's the same thing. We see the height of this pattern over here. We look for it to height up there. That's how we kind of drew our little parallel line with that. You could also, looking at this over here, I'm going to draw this like this. So we see we have pretty close to parallel lines right here. I'm going to take this over right there. And this kind of also gives us our target. So you kind of did break up above over there. Different ways, you can use the box, you can draw a line, et cetera, get to the target. We have an ascending triangle. We also have descending triangles like this. I do remember, you know, reading with, I think this dealt with Kirkpatrick, talked about this, that with ascending triangles and descending triangles, these tend to more commonly break out above than below. And I think descending tend to break out below versus above on that. But just some things to think about with that. But it doesn't always happen, but it's just something to think about. Now, just like we have those equal triangles, we do have wedges. And I was talking in a session earlier about some wedges like this. And let me shift back over here. We'll pull back up a quick chart and we'll look at SPY. I think SPY was the one I had this on. SPY also had it, but we'll actually XLK since that was right there. You zoom back out, but we see a little bit of this rising wedge like this. Again, this other rising wedge like this. And we shift back over, go to the three-month view on this. Not quite as clean, so to speak, but that could be an example of that with a rising wedge. You might also have falling wedges and such as well. Peter, why don't you talk with us real quick about Head and Shoulders?
Yeah, happy to. I think that's probably one of the, I don't know if it's just the name or if it got talked about or if it was one of the first, books about trading, but it's pretty common as far as maybe the structure, maybe it's easier to visualize. So let's once again, same thought process, talk more about the characteristics here, maybe in layman's terms, what it is that we are really seeing, and then maybe a live example or two, which can go a long way. Really, the characteristics that we're going to be thinking about are going to be that there are going to be three different peaks. It's that left shoulder, that's the head that you're seeing there in the middle, and then the right shoulder. There are some approximations here, but generally speaking, you really want those shoulders to be pretty close as far as that horizontal line is concerned. Doesn't have to be perfect. Sometimes there'll be a little bit of a, upwards tilt, downwards tilt, whatever it's going to be. But the thought process is that you've got the lower shoulders on either side of a peak there in the middle. Now, the neckline, I kind of talked about that before. That's that horizontal line where the general support is being found. That is also roughly in the neck of the woods going to be another kind of zone or area of importance where support has been found. Once again, this can have a little bit of an upward or downward tilt or trajectory to it. Doesn't have to be exactly horizontal. But often, if you're thinking about the textbook definition, this is a pretty classic example here. Now, the target price, I know we talked about a little bit. This is what I was referring to. If you take where the peak of the head is down to that neckline, if and when it was to break, maybe a generally accepted target price could be the distance between. So if this chart may be up at about 1460 down to about 1280 or so, my eyes aren't what they used to be. Maybe that's a couple bucks, maybe 20 cents shy of a couple bucks. So $1.80 on the break might take you down to about $11 or so. Once again, not a perfect science, doesn't mean that's going to happen, but there might be maybe some interest if you are trading off of this pattern or trading off of this measured move calculation, roughly at about 11 bucks or so, is where some traders may be taking profits. Now, let's go back to the thought process here. What are we seeing? Classic definition. We are in an uptrend as defined by higher highs, higher lows, higher highs, higher lows. We get up to the head. All of a sudden, we make sometimes it still is a higher low. Sometimes it's an equal distant low. And then what happens? That right shoulder. That's going to be kind of in the grand scheme of things, our first lower high. And then what happens next? Well, is it going to be kind of another equal distant low? Where is the next high going to be? How long is this pattern duration? I think classically, these are thought of as longer term patterns. If it's a head and shoulders, that's going to be classically a reversal. As defined by the head and shoulders top. Top kind of says it all, doesn't it? Point is that we were moving on the way up.
Reversing trend.
Exactly. And now are doing a bit of a trend reversal. There's a handful of patterns on real life charts. If you've got one, feel free. I think maybe AMD is one. Disney, I know, is one, Nick, that you and I had looked at not too long ago. So if we're thinking about this, okay, what
And,
is the
and
construction that
something
we're
and something I want to point out real quick with Disney is while on the slides we did have a horizontal neckline, the neckline doesn't have to be horizontal. It could be upward sloping. And there's a couple spots that you could have drawn this neckline depending on where you have the shoulder there. Do you have it based on that left side where he has it, or do you have it a little bit higher on that other second lower low? So there's a couple spots you can have it, but the big thing I want to stress is that necklines don't have to be horizontal. They could be sloping a little bit one way or the other with that.
Exactly, exactly. And this is the example of it, kind of a little bit of an upward sloping tilt to it. Like Nick was saying, do you want your line to be there? Do you want your line to be here? A little bit of that art and science, completely up to you. A little bit higher, well, then you would have had a temporary break of the neckline. You got to be mindful, but also if your shoulder would have been here, that's kind of equal distant, like we talked about, but not as robust, at least in far as the terms and how long it took to get there. So if this was more or less your neckline, given the fact that it did find support, move in, clearly it had earnings. There was a binary event here. Also on this left shoulder. Now, is this the shoulder you're depicting? Is this the shoulder that you're depicting? Is it kind of a zone of these couple shoulders that you're kind of keying in on as far as where this level of maybe resistance came in? We've got our peak here in the middle as far as the head is concerned. Right shoulder binary event break of that neckline, and then moving lower at this point in time. Now, in speaking about this, of course, measured move would more or less just be if you're thinking about these levels, depending on where you're putting your neckline. Here is maybe a break. We're talking what? More than $10, probably what, 124-ish down to about, call it 112, so maybe $12 or so. Maybe on a break of a neckline, thinking about $12 lower than 110 should be at about 98 or maybe 100 even. Once again, I think that target prices are great from the standpoint of giving your trade based off of a pattern, some type of a framework, but you've been in sessions before with us before, you know that we are never really keying in on one indicator, one thing. You are in currently a short-term downtrend. If you are taking profits from the short side of things, what you're probably going to be looking at, rather than just a $98 price tag where you're saying, that's where I'm going to go ahead and buy to cover on my short, you might be drawing something like this to say, you know what, we're in a short-term downtrend. So long as we are making, what do I keep going back to? Lower lows, lower highs, lower lows, lower highs. I'm a happy camper. And if it gets down to 98, maybe I want to do some position management, lock in some gains. But if this begins to come back up to, let's say 100 or 103, 104, and you're on the short side of things, well, is it possible for this just to be kind of minor high, kind of this being a lower high, this being a lower high, and then continue pushing down? It is. However, that goes back to what is your trade management? What is your protocol? Is this enough of a gain, or do you want to try to hold out for more? Don't try to, of course, base your target prices solely off of what a textbook might say. That measured move is going to, potentially always be factoring in other things like those minor trends or the fractal nature of it all as well. Very quickly, because I know we're actually pushing time, my last 2 cents, I wanted to share two things based off questions that were asked. Do we have the ability maybe to view all as far as patterns are concerned? Twofold on that. The Fidelity website has the stock screener, I'm sure many of you are familiar with. Classic patterns are ones that you can actually view and screen for. Head and shoulders, double tops, double bottoms. Those are all there on the screener tool. Chart Plus also has the ability to scan for these kind of in the background. And you also have the ability through the technical analysis, patterns, and events. Third-party Recognia that we have has these scans, and Classic Patterns has its own categories. So for instance, if you didn't want to be drawing head and shoulders tops yourself, but wanted to maybe go through a list of different positions and see if there were any patterns like head and shoulders, or you can select all, you can click on apply. And what that's going to do in the background is go ahead and give us a pane underneath, an understudy. You've got the ability to hover over these. Wouldn't you know, it's two head and shoulders, and I'd be willing to bet it's going to probably draw it
Different
one
shoulders, yeah.
with this shoulder, two with that shoulder, kind of like we already spoke to. The beauty here is, folks, if you click on the icon, it'll give you a little menu. The beauty is you can learn and simultaneously add it to the chart so that it's doing the heavy lifting for you. It's going to tell you a little bit about what we talked about so far. There's going to be a link that will launch out to the Recognia kind of learning center, so to speak, that they have. And it'll tell you much of what we talked about before, maybe a little bit of a different tone to it. And then you've also got the ability to click on add to chart. And what that will do in the background for us is actually go ahead and what do you know? They're going to go ahead and show, okay, we were in an uptrend. We had one peak. We retested, had another peak, retested, had another shoulder, and then maybe have been breaking this. So is their line exactly like mine? No, it's a little bit different. Just like Nick said, I can actually remove mine, can remove these different ball, and you can see, okay, did they have it exactly where mine was? No, not necessarily, but it's within the beaten path of what it is that we're trying to accomplish. The secondary one here as well, keying in on kind of the
Different
next,
shoulder
minor
over there.
low.
Yeah.
Very, very similar in that tone itself, but it'll actually go ahead and speak to that quite a bit. And here is their target price range, at least based off their peaks, their valleys, where the breakout was occurring 94, 97. I had just mental math said roughly 98 without actually doing the calculations themselves. So that's the beauty of this, regardless of the patterns you're looking at. They'll give you more context. They'll give you another
Hmm.
avenue to increase your learning. And then they'll give you the ability to look at maybe some generally accepted kind of target prices. The last thing, Nick, and then I'll turn it over to you because I got to run, was going to be a question came through about Fibonacci's. Fibonacci's we did not talk about quite as much, but the question came in maybe on using the cues. If you've identified a downtrend, and then you are seeing the retracement levels, but want to have additional retracements posted, click on the actual drawn object itself. And what that will do is allow you to type in, let's say 138.2 as an additional
And
value. If you click on add value, that'll go ahead and then have those what are referred to as Fibonacci extensions up and
and
above. So if you wanted to see 161.8, 138.2, 26, whatever it's going to be, you can add those values, whether you're in the
and the
Fibonacci retracement of a downtrend or uptrend.
and the issue with this, of course, is this is a retracement tool, not an extension tool. So if you could, Peter, the bottom of the Fibonacci where it's at 0, or you have it drawing all the way down to that bottom there, drag that over to the left so that the line is upward sloping instead of downward sloping, which keeps it the same level. No, not all the way down there. You keep it, drag it back up so it's at the same level as at 415. So we see the top and the bottom at the same level. Now release it, let it go. We see, boom, now it shifted the lines the other way. So this is retracing a downtrend on that. It's not showing extensions. So if you want to have it show extensions, you just have to flip-flop the slope of the line, and then it will do that. And so this is how Peter has it set up. If you're then wanting to see, hey, it's doing this line here, you want to show extensions like that. This is how you would do extensions, is actually having it kind of using as that retracement level with that. We do have some classes where we actually dive into Fibonacci. Usually spend half an hour just on Fibonacci's. The other thing I want to stress with like Disney, I really like with Disney, I really like with their cognitive tool, is it talked about the trend into the pattern, the upward trend into the pattern lasting for um, 95 days. And it shows that upward trend in the pattern. I think that's really, really positive that it does show that. We see inbound trend duration 95 days, and it shows that this is reversing that particular trend. Now, something I wanted to just very, very briefly wrap us up on, and I apologize we've gone a little bit longer. And I know this is the last class. We've tried to also answer some questions in here. Is if you could shift this over to FXI and take a look at maybe a 6-month basis on FXI, just like you have it there. We can then see coming into this, we have kind of a bottomed out, and it was making a little bit of an uptrend, and really it boom blew up a lot higher, an explosive move. This is now an example of maybe a flagging pattern, a pennant pattern, where this is kind of a continuation pattern. It's a little bit different than what we talked about before on a reversal pattern. This is a potential continuation pattern that we have with that. And I'll just go ahead and steal your screen real quick to kind of show what I'm addressing with this right here, from just the slide basis, kind of going up, that explosive upward move that we have. And so shifting back over that 6-month basis, you have this is the regular trend, but we have explosive departure up here. And then now it's kind of flagging back down. And really this kind of shows that break that we had here where it really broke up higher and now it's flagging back down. If this comes all the way back down, well, then it's not that continuation pattern. So really this is looking at market want to digest this and then continue that high upward move. Something else I wanted to point out with this particular security is shift back over here, that little longer term time frame. Actually, we'll keep it on the 2-year basis. You can see a lot of these types of potential patterns forming again, these consolidations like this and such. I thought I'd show a little bit of an example of, potential falling wedge. Now, this one isn't nearly as pretty, so to speak, as Costco on here, but we see it's kind of getting tighter and tighter and tighter. Downside breakout, come up, and then broke out up above this over here. With that, though, we are almost 15 minutes past time on the session. We do want to thank everyone for joining us, for spending 4 weeks with us. For those that have joined us for all 4 weeks, hopefully you found this to be a good and valuable use of your time. Something else I want to share real quick is just a couple different tools for those that want to learn more. I'm going to shift over to the kind of the technical indicator guide and such, different things that we have. Let me go ahead and share back my screen again. So, with this, you come to news and research and then learning center. From here, there are a couple different places you can go. If you go to events, and then of course, we have coaching and classes. I'm going to open up both of these in new tabs. So our classes, you can get to this by going to fidelity.com/classroom or classrooms. This will take you to this page. This is where we had our 4-week-long class on technical analysis. We also have some options classes. We also have Active Trader Pro classes and such. I'm going to click here to expand this. For those that had a couple people that mentioned this is the first week they attended that would like to then go back and attend weeks 1 through 3. We have May's classes. Here's June's. June's will start Thursday, the 6th, June 6th, and they're at 2:30. July kind of kept the 2:30, but I do believe we shift the day of the week on this. We try to shift the time, the day of the week each time. And then of course, when next week, May will drop off here and you'll be able to see and register for the August classes. This link, you'll just have to register. You'll click on this. It'll register you for all 4 weeks. You'll get reminder emails each week on about an hour before that class starts. Now, these are of course, the classrooms. This is where you can download the slides in addition to the homework assignments as well. I do believe, though, this might only be showing part of the slides versus all the slides because I have a couple different slide decks with this. But we can also come if you want to learn more about technical analysis over and above this. This is the coaching sessions at fidelity.com/coaching. Find a session on technical analysis. We're currently in the process of getting our classes up for June. They're not all here in June yet. But we do have a couple more classes. You want to learn more about setting stops? We have stops there. A lot of great classes, so to speak. And here's, of course, where you can then register for a technical analysis classroom as well. And this is where we have them broken down to week 1, week 2, week 3, week 4, versus one big class from that standpoint. Now, for those that want to catch some of the replays we might have, these sessions we don't actually record and post online. It might show it's being recorded, but it's being recorded simply for compliance purposes so that my manager and Peter's manager can review these particular classes. But if you come here and you search for different classes, like trading patterns and technical analysis here, and from here, you look down below at the different ones. We have 57-minute video, identifying chart patterns with technical analysis. Pull this back up. This is a webinar version that we've done of this class. You can also grab the slides right here, and this can give you a little bit of a replay. Now, it's not going to be Peter and I. There's some of our other colleagues on the desk that presented this, but here's another session you can do with this, and the same thing with these other classes that we have. We'll click learn more and register on here. See, this breaks it down, week 1, week 2, week 3. Again, homework and slides right here. If you search for technical analysis building blocks, you'll find recorded versions of these particular sessions as well. So we did get quite a few questions on that, on where can I find order version of these classes, where can I find the slides. This is where you can find that. This is also where you can sign up to catch it again next week. And we'd be happy to have everyone come back and join us for other classes, continue that learning process. With that said, we do have to leave you now. Thank you for joining us. Thank you for spending an hour and 15 minutes of your afternoon with us. I do apologize for running a little bit late with this particular class. Thank you for spending the month with us, for those that joined us for all 4 weeks. We really do appreciate it, and we do look forward to seeing everyone again in some future classes. Take care, everyone.